Okay, welcome everybody. We're just a minute away here, so I figure I just jump on now and take care of a couple of housekeeping items. First and foremost, I'd like to thank you all for joining us today to learn a little bit more about SSQ and our whole life product and the opportunities inherent in that. I know there are a lot of webinars going on with the pandemic, and really, I appreciate you joining us here and spending your time with us. So with that being said, just a couple of housekeeping items. We will be offering 1 CE credit for today's session. Expect the session to last about an hour or so, maybe a little less, but I'll stick around for some Q&A after if you guys have any. The voice chat is muted throughout just to prevent any disruptions, but the chat box is open. So if you have any questions, feel free to type those in there, and I will try to address as many of those as I can at the end of the presentation. So my name is Jeff Mo. I'm the Director of Business Development, covering both our individual life as well as our investment platform for British Columbia. And I'm joined today with my business associate, Stephen Paul, on the inside desk, who's going to be helping me on the tech side and monitoring the chat. And he'll be sharing some information about your sales reps, your individual sales reps in each of your regions or provinces at the end of the presentation as well. So without further ado, I'm just going to jump right in and chat with you guys about the opportunities with a non-participating whole life policy, with a focus, of course, on the SSQ non-par product. All right, so just a quick agenda for today. We'll be going through the features of the SSQ whole life, the opportunities both in the personal and corporate markets. We'll do a couple of case studies, around the corporate market area, and then I'll show you a little bit about what's new about the non-par whole life here at SSQ with some of the features that we've included now in our illustration software. All right, so features and attributes of the SSQ whole life product. Now, I don't want to spend too much time featuring the product here, but bear with me. It is important to know and understand these features to really get the full scope of the case studies and where the non-par whole life really shines in its value. So I'll spend a little bit of time on this. So mainly, when we're looking at features that clients are looking for, really, it's the guarantee. It's high on their priority list, right? And with the non-par whole life, you're looking at guaranteed death benefit, right? So the illustration that you generate today and the cash values and the death benefits that you see today are going to be the same as when you check the policy 10, 20, 30 years from now. They're guaranteed at time of application, and those are locked in, right? So that's really key for clients looking for that security and that guaranteed death. Along with the guarantees, clients have the option or a couple of features included as a paid up policy within either a 20 pay or a life pay. We start generating guaranteed cash values starting on the 10th anniversary. And you also have the option of a reduced paid up protection, also starting on the 10th policy anniversary. Cash values are fairly straightforward. What I mean by the reduced paid up protection is the ability to stop paying premiums into the policy, but still keep a certain level of life benefit or death benefit for the life of the policy. That starts at year 10. You're obviously not getting the full death benefit if you decide to stop paying your premiums, but you're still guaranteed a certain level of death benefit if you stopped paying after year 10. And that's going to come into play later on when we discuss our case. So just keep that in mind. Guaranteed cash values at year 10, reduced paid up protection also starting on year 10. Fairly simple, not a lot of bells and whistles as part of this whole life, but that's the beauty in it. It's simple, it's easy to understand, and it has guarantees, which should make it fairly attractive depending on the client need. All right, so when you're thinking about opportunities for a product that provides guarantees in both cash values and death benefits on a permanent basis, this product can be useful on both the personal and corporate side. to meet certain objectives. On the personal side, well, obviously, clients looking to have guaranteed permanent protection with a known death benefit, right? So less moving parts. There's no downward pressure on dividends, as an example, or a fluctuation of dividends. There's no market exposure. So cash values don't go up and down according to volatility. So really, for that risk adverse client that's looking for a permanent product that has some cash values and is guaranteed from day one, right? So that illustration that you hand them or that you send them is as good as it is today as it is in 20 years, like I mentioned. On the corporate side, well, you're looking at the guaranteed protection compared to the alternatives. You've got some flexibility built in with the reduced paid up feature, right? So if you decided to stop paying premiums into the policy, you still have a permanent policy in place. And there may be certain opportunities or certain scenarios in which cash values are not a priority. And that sounds a little bit odd. Usually cash values are a good thing, and I'm not saying that they're not. But in certain scenarios, it might not be a priority, and it may present an opportunity for some cost savings by going with a non-par product. So I'll go into that a little bit more as we discuss our case studies. But just to preface that whole discussion, just keep in mind that for certain scenarios where cash values aren't a priority, the non-par whole life product may make a lot of sense. Okay, so on the personal side, just to quickly touch base and go into a little bit more detail here, you could use this to start a very affordable, very competitively priced child policy with lower premiums than the alternative. Right, that's one option. If you're providing protection for a family, for income replacement, SSQ can look at insuring family members from an underwriting perspective of up to 10 to 20 times salary basis, depending on age. If you're doing some estate planning, funding a policy can provide that liquidity for death, for taxes at death, including probate fees, funeral costs, and other costs associated with that can be funded through this life insurance policy. For clients who want to give back, charitable clients who want to give back to the community, a permanent policy funded with efficient cash flow will provide guarantees for both the client as well as the charity. And as we're all familiar, charities do prefer guaranteed permanent policies rather than temporary term policies. So that's another avenue to look at. Also, potentially for clients who are looking to equalize a family situation with their estate. As an example, family members that are in the family business, for example, or a family member who might be disabled and you want to equalize that estate, a permanent life insurance policy is a great way to achieve that goal. For those who are going through marriage breakdown, separation, right? This could be very useful in the sense that you could use it to ensure the payer of the support payments. And in certain cases, this might be required by law or by the agreement drafted up that the person be insured so that they can keep making, so that they guarantee those payments to the spouse or to the child if the payer passes away. All right, so on the corporate side, what are some of the opportunities? Well, you can efficiently insure a person that is key to the organization, a key person protection. When a shareholder dies, they're deemed to have disposed of their shares at fair market value, right? So shareholders that own shares also face this tax liability. This can be in the millions of dollars, and the insurance can be used to fund this tax liability. That's an option. And more interestingly, if we go a little bit deeper into the estate planning side, for those clients that have implemented an estate freeze or potentially looking at an estate freeze can also benefit from insuring themselves to fund the inherent tax liability. So to kind of highlight that, we're going to look at a couple of case studies here. On case one, we're going to look at how corporate insurance works with an estate freeze. In case two, we're going to look at a dual solution, layering in permanent insurance along with a little bit of term in the corporate market, and we'll see the advantages and potential opportunities of each of those studies. All right, so Whole Life 20 with the framework of looking at an estate freeze. There we go. Okay, so case one. Well, we're thinking about a pretty common corporate structure here. We've got a parent with some children here, and the parent here is the owner of this corporation, here, valued at $1.5 million or so, right? So these are common shares at $1.5 million. We can assume that these shares have very minimal ACB and very little paid up capital. Going back to our conversation on the previous slides, the parent's going to have an inherent tax liability on these shares if they still hold these shares at time of death, right? So we can assume that the estimated tax liability to be 1.5 mil, 50% capital gains tax at the marginal rate of 50%, just using some rough numbers here. Your marginal tax rate is at about, or your tax liability is $375,000 in this case, right? So these are common shares. You're liable for their fair market value at time of death. You're deemed to have disposed of them. And if the company continues to grow and the parent continues to hold these shares, the value of the shares, well, potentially will increase, right? And so does the inherent tax liability of those shares as well, right? So really, we can make a very solid case doing this estate freeze here to help free up some of that tax liability and to make things a little bit more efficient for both the parent and the heirs of the company. So some considerations. What is the inherent tax liability? The parent may have some questions about their corporation, the succession, and the estate planning. How does the parent bring the child into the business on a tax-deferred basis? Where does the liquidity come from to pay for the tax liability associated with his shares? How can the parent freeze the growing tax liability on his shares if he continues to hold them? And what are some potential solutions out there, and what can we look at? So in this case, an estate freeze can be a tax planning option that the accountant may suggest to help mitigate or assist in the considerations. Right? The probable main driver for implementing estate freeze is to minimize the income tax on the deaths as a result of a deemed disposition. And in general, the objective is typically the same, is to establish a cap or a freeze on the value of shares held by the parent and enable future growth to accrue to a different shareholder, usually the next generation or the heir to the business. This is the basic essence of almost all estate freezes, right? So the main goal here is to lock in the value of those shares at $1.5 million and to convert those common shares to preferred shares. The parent in this case still retains control of the corporation by holding those preferred shares, but they've locked in the growth at 1.5. We switch those out for common shares and we issue those common shares either directly to the heirs if they're of age, or in certain cases, you might start a family trust if they are minors, if there's any further planning requiring a family trust, right? So we're switching out the common shares, locking in those values with preferred shares, and giving those common shares to your children at a value of 0, and then you're deferring the growth of those common shares to a later point in time to those children. So this is what it could potentially look like, right? So fair market value of those common shares, again, $1.5 million. We've converted that to preferred shares. There's no more growth in the preferred shares. So essentially what we've done here is we've solved for X. We know what the value of those shares are. They're locked in. We know what the tax liability is, and we know what the value of those shares are, right? So that's important. We've funneled those shares into a family trust of common shares at fair market value, and the growth is going to happen on a tax-deferred basis. Now, if the parents complete the freeze by giving the shares to the children actually own the shares, right? So to note, as shareholders, the children should be parties to a shareholder agreement. This is definitely a consideration when you're planning an estate freeze. And therefore, as a discretionary family trust is often used, if a discretionary trust is used to hold shares for future distribution to the children, then the parents or the trustees have up to 21 years to decide who should become a shareholder. right? So these are just little notes about how the estate freeze works, right? But essentially, by doing an estate freeze, we've locked in that value, like I mentioned. So we know exactly the value of those preferred shares, and there is no growth, right? So there is no increasing death benefit requirement to cover those shares, right? So is an increasing death benefit or an increasing cash value permanent solution valuable in this situation? Well, maybe, but maybe not, right? So maybe you do want that increase in cash value to help generate that nominal CDA account, right? That could be the case. But even then, it's not as straightforward as it seems. Increasing cash values does not always generate efficient CDA. And I'll show you guys what I mean by that in a couple of more slides here. But just a question to think about here. If we've locked in the value of those preferred shares and we know what the tax liability is there a benefit in having a guaranteed product that has no increase in cash values and in fact could potentially be paid up in X number of years? Well, yeah, I think so. All right, so and this estate freeze can fix the amount of capital gains tax. So generally it does not make the tax go away, right? It's just deferred, nor does it provide the means to pay the tax. This is where life insurance comes in, right? You can use that to be an integral part of the planning process. And in this case, an insurance in the amount of $1.5 million can be used to redeem the parent upon their death. Now, if we go a little bit further and go into what we call a wasting freeze. A wasting freeze is a situation in which maybe the accountant suggests that the parent draws down on their preferred shares to maintain their lifestyle, for example, right? So by drawing out of your preferred shares via dividends, as an example, so let's say we start with $1.5 million and you're taking out a dividend of, let's say, $100,000 in this scenario. Well, the value of the shares is decreased proportionately by that amount. So you're going by 1.5 million down to 1.4 million in value, right? So a couple of key things about this type of planning can take place over a number of years or decades, right? So having a permanent policy in place definitely helps. But more interestingly, because it reduces the value of the preferred shares, there is some synergy to be had with, and this is going to sound odd, with a decreasing cash value policy. Decreasing cash value, why? Right? Why? Well, because you're saving on premium, right? So what I mean by decreasing cash value is, remember when I mentioned that we have a reduced paid up protection as part of the SSQ whole life, meaning that after year 10, at any point in time, you could decide to stop paying premiums into the policy and still have a nominal amount of life insurance coverage. So if you're drawing down on your preferred shares and reducing the value of it, well, technically your death benefit is, you can reduce that as well, or you can reduce the cash value associated to cover that, right? So you could potentially be paying up your whole life policy much sooner by just stopping premiums into it to match the drawdown on the preferred shares. Right? So when you think about it that way, a permanent policy with a reduced cash flow requirement, right, less premiums, it could be very potentially advantageous to this situation here. Right? So when suggesting insurance in an estate freeze, having a guaranteed policy with little to no cash value is valuable. Right? The death benefit does not need to increase over time. And the benefits of the reduced paid up option will certainly be a feature to discuss with your clients. Right? So, there is no one size fits all for an estate planning solution here. This is simply an option, and there is an argument to be made to save on those premiums, and SSQ's non-par whole life can certainly be part of that discussion. And with less cash flow needs compared to the alternative, it can make a lot of sense. And we're more than happy to work with tax professionals to show them the benefits of those savings. All right. So let's look at case study number 2 here. Dual corporate solution. And what I mean by that is layering a bit of the permanent whole life with some term insurance to provide a little bit more flexibility uh, and providing a different perspective. All right, so what are some of the benefits of combining term and permanent, right? And when I'm speaking about permanent here is the SSQ whole life permanent with a reduced cash flow requirement. It's cheaper, right? That's what I mean by that. Well, by layering in term, you have a little bit more flexibility in terms of cost. You have the ability to convert the product to a permanent solution at a later point in time if the client's needs change. But more interestingly is the manufacturing of CDA, the efficient manufacturing of CDA, actually. So let's take a step back and just remember how CDA is generated in a life insurance policy, right? CDA is your death benefit minus your ACB, right? Death benefit minus ACB. Now, inherently, all permanent products with cash values will be able to generate that CDA for you, but is it efficient? That's the key here, right? So in the case of a par product, the ACB may not drop to zero until age 90 or possibly even later, right? So is there a way to kind of shift the numbers, shift the values a little bit and manufacture some additional CDA? Well, yeah. Well, terms the answer to that, right? So remember, the formula is death benefit minus ACV. Well, a term product is going to give you a lot of death benefit for the term. It has little to no ACV, right? So we're adding a lot on the upside on the death benefit with very little added to the ACV. So by layering in a term into a permanent product, we've effectively manufactured CDA at a much earlier time, right? So I'll show you guys with an example here, but I'll jump back to the slide afterwards. So, okay, here's the example. So we're looking at a male non-smoker, age 50, with again $1.5 million in valuation here. And we're going to look at the SSQ whole life non-par versus company 2 with a par product. So on the left-hand side here, we'll see premiums for SSQ are about 40,000, and for company 2 about 52,000 or so. Looking at the surface level, we're looking at a death benefit at age 85 with SSQ, guaranteed at 1.5 mil, and with the par product 1.9. Right, so it does look a little bit better with the par product. Okay, fair enough. And on the CDA generation side, yeah, okay. So on the SSQ one, you're looking at 1.1 mil approximately, and about 1.4 mil with the par product of company 2. Right, so on the surface, it does seem like that the par product is better. Sure. Keep in mind that you did pay more for the par product here. So over the span of 20 years, the difference in premium paid in the SSQ whole life versus the par whole life of company 2 is $264,000. That's the difference in premium over a 20-year span. So a case can be made that we should take that $264,000 and invest that into a term product. In this case, term 35, right, leading up to client's 85th birthday here. And remember, because CDA is death benefit minus ACB, there's very little ACB associated with the term product. By using that $264,000 in saved premium towards a term product, we have now generated or manufactured that additional CDA. And now the new CDA with your whole life plus term 35 rider is at $2.1 million compared to the 1.4 of just a straight up par product from company 2. And this is at age 85, right? So this is happening, the CDA we're generating is a lot more, and it's happening sooner. It's happening at age 85 versus potentially age 90 and above, right? So is it the right fit for every single client? No, but is there a case to be made for it? Absolutely, absolutely. And On top of that, SSQ offers a very flexible term solution as well. And I'll jump back to the previous slide. Here at SSQ, we offer everything from a T10 all the way up to a T40 in 5-year intervals, right? Very, very flexible, very, very competitively priced. But not only that, our Term Plus product can come as a combo package with very affordable and creative riders, right? We have a total disability rider, which is a loan insurance product, and a life underwritten only CI product for $20,000. By life underwritten, I mean that if you're rated standard or better on your life insurance, then you're automatically approved for this $20,000 CI. Now, I don't want to jump into too many details of the total DI or the CI rider because today isn't a term presentation. If you guys have any additional questions about our Term Plus combo package, please do feel free to either watch our previous webinars that we've hosted and saved on YouTube, or to ask your local sales rep. More than happy to share that information with you. But the point of it, of showing you this today, is that by taking that $264,000 worth of saved premium, we can introduce a term product that not only generates that CDA, but can provide additional features like the total DI and the CI rider for a more holistic solution. So along with the term product, you of course also have the flexibility of converting that product to a permanent solution, of course, right? So if the needs change and the term doesn't fit the bill anymore, you always have the option to convert either to a whole life product like we discussed today, either a whole life 20 pay or a whole life 100. Again, with the same features, guaranteed cash values, reduced paid up coverage starting at the 10th year. We also have UL available at SSQ. We have a super hyper competitive warranty UL. We've got a level T100 UL with 20 investment accounts and guaranteed interest accounts, so very flexible and very diverse. And of course, you could also choose our T100 or Term 100. And of course, I'm preaching to the choir here, but conversion to a permanent product could be a solution for those who aren't insurable at that time. Recently, we've upped our conversion age from age 70 to age 71. It may not seem like a big deal, but what we saw as a missed opportunity is maybe for those of you who did investment business as well and hadn't had a chance to speak to your client about their life insurance policy until their RIF conversion at age 71, then you probably would have missed the boat. So by upping the conversion age to age 71, we feel like that's a nice quality of life improvement. Just to have that same conversation to convert to a permanent policy and do a RIF conversion at the same. So minor change here, but we feel like it's beneficial. And of course, once that date is reached, the only options are either to renew on your term or to apply for a new coverage subject to the insurability requirement. All right, so just to jump into a couple of the features of whole life in the SSQ illustration software. Okay, so new features. We've recently repriced and relooked at our whole life product, so it's a great time to start exploring our non-par whole life. We did a repricing on our whole life life pay and our T100. We also looked at readjusting cash values and the reduced paid up protection values on both our whole life 20 pay as well as our whole life life pay. We've got some new features available on the software, the internal rate of return, the reduced paid up protection, etc. So you can generate these pages either via the custom reports button and adding those pages onto the illustration software, or you can generate as part of an Excel spreadsheet to see the values there as well. So if you have any questions or concerns about how to run the illustrations or how to add the features onto it, please feel free to either give us a call or reach out to your local sales rep. More than happy to walk you through. Additionally, we provide a way to solve backwards as well, right? So if you wanted to solve for cash value instead of face amount, or to solve for reduced paid up protection instead of the death benefit, you can plug those numbers in and the software can solve backwards to provide that premium or the face amount according to the values that you've set. So either way, bottom up, top down, however you want to solve for your life insurance solution, the software can provide that functionality for you. Okay, so just to bring everything together here, there is no one size fits all for an estate planning solution for a corporate account, right? So it's about understanding the features of the different permanent products, and understanding the SSQ whole life features may help you with opportunities in different markets, right? The key note here is to make that comparison of a minimized cash flow, right? Obviously, a non-par product, simpler to understand, less expensive, and comes with its own fee, right? In the case where, again, cash value may not be a priority in the case of an estate freeze, right? Because we're freezing and locking in the value of those preferred shares. Solving for X may not require for a permanent life policy that has increasing death benefit or increasing cash value associated. And paying those additional premiums for those features may not be in the benefit of the client. It might be, but it may not, right? So it's about understanding the situation, right? And again, with our case study number 2, is looking at the cost savings and taking that savings, that chunk of savings, and potentially layering in a dual approach by combining some permanent and some term insurance to really tie everything in together to make it a little bit more holistic and making that CDA generation a little bit more tax, not tax efficient. Well, generating that CDA at an earlier point in time for the client. Right? And of course, you do have that flexibility in the term product in both the riders made available, right? The loan insurance rider, the CI rider, that is life underwritten only, as well as the option to convert that product up to their 71st birthday, either a whole life solution, a UL solution, a T100 solution. All right, so that about wraps it up here. I guess we ended a little bit sooner than expected, but I'm going to stay around and help answer any Q&A questions that you guys might have. I'm going to pass the control over to Stephen. He's going to be sharing a screen of all the contact info for your local representatives if you have any additional follow-up questions or if you want one-on-one sessions to discuss this presentation. So Stephen, go ahead when you're ready. Okay, so Sergey asked, hi, Jeff. Are there examples when whole life can be purchased for a single payment? For the clients who may not have future cash flow, but they have some cash they'd like to push into a whole life? Not in this scenario, because there's no overfunding involved in these scenarios here. I mean, you can do a 20 pay into a whole life and pay it down a little bit earlier. Because our simple whole life does not build any, does not have a pool, there is no overfunding of the simple non-par whole life. Yeah, for that you may want to look at par in that situation, or even a UL, depending on the client's requirements. If they're looking at it as a life insurance policy or a sheltered investment product, yeah, those would probably be better options. Jamoki Johnson, I hope I'm not butchering your name here. Do I have time for a one-on-one? Yes, I'll reach out to you individually, Jamoki, and we can set something up. So yeah, during conversion, there is no further proof of insurability required, but you do convert at attained age. All right, so it doesn't look like there are any more questions at this time. I'll just give it a couple of more minutes here. And after that, I'll just sign off and close the session at that point. So just a couple more minutes. If you have anything else, feel free to type now. Otherwise, I'll be logging off at around in about 4 minutes or so. Okay. Pankaj, you say you need some training on UL products. Yeah, absolutely. Feel free to reach out to your local sales rep in your area. More than happy to go through some UL product training with you. Can a client whole lump sum to pay the 20 whole life in one shot instead of paying annually? No, I do not believe so, no. Yeah, Pankaj, your sales rep will be more than happy to go through the different quotes with you and do a comparison for you, absolutely. Modesto, yes, we are issuing one CE credit for today's event. You'll be getting that along with a copy of the presentation via email. Modesto, yes. Okay, yeah. So you can do contracting with SSQ without submitting your first case, without even submitting a first case of business, right? So we leave the contracting work to the MGAs. Everyone has their own process. I would suggest that you reach out to your contracting rep at IDC Win and have them initiate the contracting process on your behalf. And like I said, you don't need a first case of business to get contracting started on our side. Hua Sue, hi Sue. Yes, the webinar ended a little bit sooner than expected, but it did end. So if you want additional information or you feel like you missed some key parts of the presentation, do feel free to reach out to your local sales rep and we can go through that information with you again. All right, so I think that about wraps it up. Thank you all again for joining us today. You'll be getting a copy of the presentation and the CE credits via email. Like I mentioned before, please do feel free to reach out to your individual sales reps as shown on the screen right now for additional concerns, questions, help with the coding software, or even just to review SSQ as a company. Again, thank you for joining us today. We look forward to seeing you at our next webinar. Have a great day, everybody.